The Minority Market. Episode 71. How Market Psychology Creates Trends. Most people think trends happen because of news, earnings, or economic events. The minority understands a deeper truth. Trends are created and sustained by human psychology. Markets do not move in straight lines. They move because millions of participants slowly shift beliefs, emotions, and expectations over time. Every trend begins with uncertainty. At the early stage, only a small group of participants recognizes opportunity. Price starts moving quietly. The majority ignores it because there is no excitement yet. This is the accumulation phase. Smart money enters slowly, without creating attention. As price continues to rise, more people notice. Early adopters gain confidence. Media begins reporting positive stories. Optimism increases. This is the participation phase. More buyers join. Momentum builds. Trend becomes visible. Later, emotional participants enter aggressively. Fear of missing out dominates behavior. People chase price without planning. Social media hype grows. Overconfidence spreads. This is the late-stage phase. Risk increases even though excitement feels highest. Finally, exhaustion appears. Smart money starts exiting quietly. Volume, behavior changes. Price struggles to move higher. Small negative events trigger panic. The crowd sells emotionally. Trend reverses or enters consolidation. This entire cycle repeats because human psychology repeats. Greed, fear, hope, denial, and regret operate the same way across generations. Technology changes. Emotions do not. The minority trains to identify these psychological stages instead of reacting emotionally. They avoid entering when excitement is extreme. They prefer early or middle phases where risk-reward is healthier. Another reason trends persist is confirmation bias. Once people believe a trend exists, they selectively see information that supports it. Positive news is amplified. Negative data is ignored. This bias strengthens momentum until reality forces adjustment. Herd behavior also strengthens trends. Humans feel safer following crowds. When everyone buys, individuals feel justified. When everyone sells, panic spreads faster. Markets amplify this instinct. Institutions understand this behavior deeply. They use psychological waves to accumulate and distribute positions efficiently. Retail traders, often unknowingly, provide liquidity during emotional extremes. Trends also survive pullbacks because of belief reinforcement. During an uptrend, small dips are seen as buying opportunities. During downtrends, small bounces are treated as selling chances. This reinforces directional bias. The minority does not fight strong trends emotionally. They respect momentum but remain cautious of late-stage behavior. They use structure, not excitement, to guide decisions. Understanding trend psychology also improves patience. Trends take time to develop. Beginners expect instant movement. The minority understands that slow progress often leads to stronger outcomes. Another important insight is that trends exist across time frames. Short-term trends form within larger trends. Aligning with higher time frame direction improves probability and emotional stability. The minority also avoids prediction obsession. They focus on participation, not prophecy. They adapt as psychology shifts instead of clinging to fixed opinions. When you understand how trends form psychologically, you stop being surprised by market behavior. You recognize excitement peaks. You identify fear-driven sell-offs. You act strategically instead of emotionally. This awareness reduces impulsive trading. It builds discipline. It strengthens decision confidence. Trends are not magic. They are emotional waves. Learning to ride them calmly is a core minority skill. Remember, price does not move randomly. It moves because people react, repeat mistakes, and follow crowds. When you understand this cycle, you stop being part of the emotional crowd and start acting with structure. This mindset shift is essential for long-term survival and consistent performance. In the next episode, we will explore why traders fail when they believe they control the market and how the illusion of control damages decision-making.